However you look at it, there's definitely been an impact on the market. The latest Q2 figures are not yet in, but I think anecdotally most of us would probably agree that there's been a significant slowdown, not just, by the way, for commercial property, but also business investment generally, which is one of the reasons that the UK performance, I think, has slipped a little bit in terms of GDP growth and whatnot. If we look at the Q1 volumes here, the latest data we have, you can see there's a quite significant downturn, certainly by the UK, which is down about 35%. I think it was year on year for the quarter, as it were. And it runs pretty much right across the rest of Europe. I think Q1 was driven probably less by Brexit worries and more about, you remember the economic turmoil we had back in January. Equity markets were off by 10%, as it were. I think when I looked at the EPRA indices, they were down even 15–20% on some of them. The REITs have seemed to have made a bit of a recovery, but there was a huge thing going on then. I think part of it was the U.S. rate rise, some disappointing figures out of the U.S. Then there was China, of course, and all the usual suspects. Q2, though, I think there's a little bit more stability, if not significant growth in the world economy. Hence, I think probably what we're seeing now is definitely the pre-referendum risks weighing into the equation, and has really definitely slowed things down. This is more data of the same, a different set of countries. You can see Russia's pretty much disappeared. Portugal seems to be quite buoyant for, well, it's a small economy, so it doesn't take much to keep it going, I suppose. But generally, the message is pretty clear across the board. And you could be forgiven looking at this one, that thinking that we're seeing what we're really seeing is not necessarily EU referendum, but just simply what's described by many as late cycle pricing and risk impacting. And the story in London is very, very clear that yields have fallen to, well, pre-peak levels, as it were, previous peak levels. And also the UK regional cities have seen quite considerable yield compression too, as you know. And when you look around Europe, I took the German cities here as an example, all sort of more prime cities, as it were. And again, the yields are down at very low levels. I think a lot of this has to do with just simply the weight of capital and also the extraordinary low interest rate environment. But when I was at MIPIM, I started asking some of the funds and the REITs that I met there just to explain why they were sitting on so much cash and not putting it to work. Apparently, there were several actually confessing to the fact they had 25% of their funds held in cash, and that seemed quite extraordinary. And so you ask people, they're never really going to tell you too much, are they? But I guess the main thing that I kept hearing over and over again was late cycle risks, which is property talk for high prices, I think, and the fact that a correction may be underway. Then there's a lack of opportunity, which basically just means that there's a lack of product. Then there was fear of redemptions, which, if you remember back in February, on the back of all the economic turmoil we had in January, we had some record outflows from the funds, certainly in the UK, and I think that rattled a lot of people. And so all these things are good reasons why people might want to hold on to a little bit more cash. And then I had this discussion with this one guy. He sort of let it slip that maybe the Bank of England had actually had a word with some of the institutional funds to suggest that maybe they should hold on to a bit of cash, at least until we get through the other side of the EU referendum, so that we don't run into financial stability issues. And so I called one of my journalist friends and said, here's a good one for you. And they did a bit of digging, and sure enough, there was through the Bank of England Property Forum, there was a discussion that perhaps, certainly with the larger funds, maybe there should be an inclination to kind of hold back until after the referendum, because Mark Carney and his buddies, I think, are actually pretty concerned about the short-term impacts of a vote to leave. So then I go and I had a chat to some other people, and they said to me, we're holding cash because we see an excellent opportunity to exploit a new financial crisis. And I said, what, on the back of the EU referendum? They go, no, conditions are just right in the world right now for a new financial crisis, and we just feel like one's coming. I thought, all right, if you started thinking about the geopolitical risks in the world, and you think about the US elections and all the rest, yeah, you could probably go on quite considerably and find a lot of different things that would drive a downturn, as it were. I think probably, though, the exchange rate risks around the referendum is probably got to be pretty much definitive, certainly for any sort of cross-border investments. I know there's hedging as a possibility, but even it's hard to say. It's hard to know what to hedge against at the moment. you know, like I'm not a currency analyst, but I know a little bit about it, but right now I can't even decide whether I should buy euros in anticipation of my holiday or not, because I'm not sure whether it'll go up or down, irrespective of the outturn from the referendum. So I got a note through from Oanda the other day, which is the currency trading platform that I subscribe to, and they've told me that the EU referendum presents a great opportunity for large profits, but also large losses, and hence they were going to mitigate the possible impact by reducing my ability to access leverage from 25 to 1 to 20 to 1. And I thought, yeah, this should stamp out any sort of volatility. And then I was going through the Financial Times the other day, and I see that the hedge funds are commissioning their own exit polls so that they can get, you know, about an 8-hour start on the rest of the markets in order to take positions before the formal announcements of the results of the EU referendum were taken. And even George Soros' name came up in conversation. Of course, he's well known for his actions back in the when we came out of the exchange rate mechanism back in 1992, and he made an awful lot of money on the back of that. But I think the point I wanted to make out of this particular slide is that, you know, if the referendum goes one way or the other, markets will move against the currencies in as big a way as they possibly can, because that's what markets do, that's what traders do, that's their job, as it were. So any sort of weakness that they find in the system, whether, I'm thinking primarily on the back of a Brexit, that will be exploited, and I think anything that happens will probably be magnified quite considerably over a fairly short duration. As a matter of fact, looking at the currency, which I think, I'll keep coming back to this again and again, two things to say is that, you know, if you're not put off by late cycle risks and lack of opportunity and all the rest, it's the exchange rate just has to be pretty much fundamental in any cross-border investment decision at the moment. On the, let's see, on your left-hand side, you can see that the British sterling has been moving pretty much in line with the UK polls, and I've been tracking those pretty carefully over the last, since February actually. And they moved a little bit this way and that. It's hard to know just how accurate the polls are. I've been following the bookies myself, and I can tell you that the bookies have been pretty consistent at between 70 to 75% to remain, which is kind of where I would like to hang my hat, which actually isn't too far off where we were back in 1975 when we had the last EU referendum, which came in at about 2/3 majority to remain. Do I think there'll be 2/3 of majority to remain this time? Yeah, let's go for it. At least I'd like to be optimistic about it. Let's see, so what's the vote to remain going to look like, though? That's the first thing. Because if that's the most likely outcome, perhaps that's what we should be preparing for. Is it business as usual? Is it a relief rally? Do we end up with deal gridlock, as it were? You know, I suspect there's a lot of this. I think probably the quintessential thing, though, is that, as I said before, the funds and the REITs are holding considerable cash, and just in the last couple of weeks, and I think some of our panelists can speak to this, I certainly know that UK institutions had been in the market looking for opportunities, but not necessarily pushing the button on it to wait until after the EU referendum. This suggests to me that if we do get a vote to remain, then there could actually be quite a lot of activity in a very short space of time. Does that mean that I cancel my holiday and to Thailand and come back and spend July here? I'm not so sure. But equally, I do think there's scope for quite a lot of activity. In the meantime, the international, particularly the long-term investors, the sovereign wealth funds and whatnot, a lot of these people seem to be looking right beyond the referendum. They're looking 5, 10, 15 years out, and I don't think it's really changed a lot of their investment activities. And also the type of investors that aren't so focused strictly on return, maybe into wealth preservation or whatnot, that hasn't come off either so much, I think. I think what we will see, though, is that because of the pricing in the markets, we're going to see a huge interest in secondary tier cities and assets, not just in the UK, but across Europe. As a matter of fact, we're going to kick off a little research bit at Colliers to try to investigate where we see the opportunities coming through on that. We also think that there's going to be a huge regional development agenda in the UK. If you think about the Queen's speech, the top 3 or 4 items were we're going to maintain austerity, but also we're going to do this huge push on the so-called Northern Powerhouse. And I take that to mean regional development in general, infrastructural development, and all the rest. And I think that's going to spawn opportunities that are likely to last for the next 10 years, as it were. A lot of development, and the funding, I think, will start to improve. It's still not brilliant for developers in the UK, although they say that's not their biggest problem. It is a bit easier in Europe, as I understand it. And I have to tell you that, from my own perspective, I'm a big fan of the UK regions. I see that as the potential victim if we were to vote to come out of the UK. I think that the whole regional development agenda would just absolutely collapse. I think the wealth generation in the southeast would start to separate itself from the rest of the UK. I just see political chaos, honestly. Anyway, but let's talk a little bit of chaos then. So there's a vote to leave scenario. Now this is a much shortened version of a longer, more complicated bit of work that I've done. But I think probably it's safe to say that Mark Carney was very worried to the point where he stuck his neck out and said, look, there's a financial stability issue. Matter of fact, if you read the financial stability reports that come out twice a year, I think last December there wasn't even a mention of the EU referendum. And I think there was a lot of people saying, come on guys, how about it? What is your outlook? And so he stepped into the frame and said, look, this is what we think was potentially going to happen. He's pretty adamant that sterling will go down, only by about 10% seems to be what the general consensus is. If you look at the figures from all the hedging and whatnot, it would suggest that. So 10 to 15%, which is in line with what happened when we came out of the ERM back in 1992, although it played out over about a 3-month period. But Carney said quite interestingly that he thought that the UK economy would be compromised, and in the same breath he said that the Bank of England stood ready to use all tools necessary. Now what does that mean to me? Economy compromised, all tools. They're going to raise interest rates to support sterling, which means it'll have a direct knock on household expenditure, which is the main game in town as far as the UK economy goes. So this is when this all starts to happen. Then the rating agencies take a look at the situation, and they work their magic by sort of downgrading the bonds and whatnot. The credit default swaps go up, and suddenly not only is UK bonds under attack, but so is the Euro bonds, because when the UK comes out of the EU, or is planning to, and suddenly that becomes a much weaker structure. So the rating agencies re-rate various bonds there, and then suddenly the peripherals are on the way up. Suddenly bond sales are undersubscribed. The Bank of England and the ECB both step in as buyers, effectively going through another bit of enhanced quantitative easing to support the markets. And commercial property, it's got to be a significant repricing that comes in the back of this. At the moment we're going through, I think what we've seen so far in the first half of the year is, in the UK certainly, is a moderation of yields. It's been pretty stable in the core markets, but a little bit of drifting here and there. I can't see how it would do anything but start to go from a moderate pace to what I've described euphemistically as an immoderate pace, all within the context of what Anatol Koletsky would remind us is going into the financial hurricane season. We usually have all our disasters in September, by the way. And if we survive that one, then we've got a U.S. election where Trump has the possibility of stepping up to the plate and taking the reins for a while. And I thought to myself, what's the first thing I'd do if I were Trump? So I'd probably tell all the offshore cash-holding entities in the country that that will lower corporate rate of taxation to 15% for all those funds that we actually bring back into the country. So at exactly the time that we need the investment funds in the UK, suddenly all the American guys are repatriating cash to the US because they suddenly have a holiday on offer from the taxes, as it were. I don't know, this sounds like one of those call of the IMF type scenarios. I hope it doesn't go that far, but nevertheless, this is just one possibility. We can argue about this all day long in terms of the intensity and all the rest of it. But I think this is something that just came out from logic when I was just sitting at my desk thinking. Too much time on my hands, yes? So what does it mean for commercial property? Well, first of all, let me just say a quick word about residential. Residential prime probably looks to benefit from all this, quite frankly. I think what happens is if sterling goes down by about 10%, 15%, then suddenly Central London prime will find a market with a new set of international investors coming in thinking that they have a buy opportunity. I think it's a mass market in the UK that really gets hammered, partly because of the economics in the background, and the household spending contracting and all the rest. Commercial property is a little bit of a different game. And I think what dawned on me when I thought about this for the first time is that I think it's likely to impact investors differently depending on what your investment time frames are. I think that the short-term investors will be squeezed out pretty quickly. And I think the reason is because if you want to be a short-term investor, you need to have a short-term exit strategy. And in the absence of any sort of market uncertainty, and in the midst of a major sort of political shakeout, certainly in the UK, but also EU-wide, how could you possibly plan for any sort of an exit? All right, so the downside of that is that developers are also out too, and we all know the story of the shortage of quality grade A space across all asset classes. And so at the very time that we really need these guys to be ramping up the activity, suddenly they're pushed out, as it were. Second tier, forget it. That's too much risk on. I just don't see much activity there. Redemption sales will clearly start. Fortunately, we're sitting on a bit of cash, supposedly, so maybe it's not doesn't lead to the fire sales instantly. But if you want to be opportunistic, or even if you're a fund and you're thinking you're a long-term investor, you'd be crazy to invest into a market where you anticipate more redemption pressure and knowing that some sort of pricing recorrection is coming. So there would be some stability after a while, but not until after there's been a considerable repricing episode. Meanwhile, the REITs are going to be retrenching at the same time. So in short, I mean, it looks to me like we're going to have go from a moderate sort of repricing that we're currently going through, a sort of a late cycle phase, as it were, into something that's a little bit less predictable, I would say. Personally, I could do without it. But look, one thing that hasn't changed, and I want to try to put not necessarily an optimistic picture on it, but just to show where I think the opportunities possibly are, is that there's a few things that have not changed. And one is that the international weighted capital has not gone away. If you look at global demographic pressure, pension fund requirements, and all the rest of it, there is a huge appetite still for slightly higher yielding considerably higher yielding assets compared to bonds, which are getting negative returns in many parts of the world and all the rest of it. Consequently, I read a figure the other day that we now have gone up from $1.8 trillion under management and property globally to $2 trillion in management. All the evidence is that fund allocations to property, the multi-funds are continuing to increase. You know, if you look at the private equity real estate publications that pop into your inbox all the time, it seems like there's an endless number of funds that continue to close as in terms of the fundraising and all the rest of it. And so there's a huge opportunity here to do something. The question is what? Now, I'd say the other thing to put into the frame is I mentioned demographics, and I think probably going forward for investors, and I'm thinking long-term here too, is that there's a very different demographic pattern across Europe, which I think pretty much could shape the way property investment goes for the next 10, 15 years, as it were. On the far right-hand side, you can see that the UK in the dark blue, and if you go over to the next one, which is France, is dark blue. Those are the only countries in Europe that are seeing positive population growth over the course of the next 15 years, according to Oxford Economics. And in the light blue right next to it, you can see that the workforce is just barely growing too. So that raises some challenges. But pretty much if you look at the rest of Europe, you've got the prospect of contracting populations with the workforces contracting at an even greater rate. And you go all the way over to the left-hand side, you can see Russian population is down by 5 million over the same period, with the workforce falling by about 12 to 13 million. Now the joke, which really isn't a joke, about Russia is that if you're worried about adventurism, you have to ask where the army's going to come from. So that's good news out of a very sort of mixed demographic bag. But I think what this means is, first of all, is that I think industrial and retail and leisure will all be generally, well, let me start with industrial. Industrial will be generally supported by the demographic trends, certainly in France and the UK, because you need a certain amount of infrastructure and logistics to actually support the economic growth that comes with population growth and immigration. Let's not go into that. It's a different sort of story in the rest of Europe, I think. If in fact these figures prove correct, then the pressures are probably more toward qualitatively changing the infrastructural mix or the type of multimodal mix and all the rest of it, rather than just simply putting on sheer volume of new assets, as it were. Retail and leisure tends to be a little bit more domestic focused, I think, and is a bit more survivable, certainly in the UK and other sort of markets that are driven by tourism. I think that actually, I don't want to use the word resilient, but I think that probably stays fairly steady on. Offices, I think, is where everybody agrees that the real threat is, and my own view on this, and I could go on for a half an hour about different views, is that I think the threats that come from the argument about the UK leaving, certainly, is that the clusters of expertise that exist will fragment and travel around Europe, and headquarters will move to other places and all the rest of it. I just think that's absolutely fundamentally wrong. I think that the clusters of expertise, wherever they happen to be, whether it's the new tech in Berlin or whether it's the pharma up near Cambridge, or the energy and material science in south of Nice, or wherever the cluster is, I think that's going to remain. So I wouldn't, in one way, I mean, I'm really quite alarmed by the prospect of a Brexit in the short-term problems it's going to generate. But over the longer term, I think there's actually quite a lot of interesting stuff to do.